I need to stop you right here, before the intro, before any context, before any history, because something happened yesterday that most financial channels have not connected to silver yet, and by the time they do, by the time this reaches mainstream coverage, it will be too late to act on it. An Indian tanker passed through the Strait of Hormuz yesterday, safely, without incident, while the war is still raging, while 134 other ships sit anchored outside, waiting. How? It was paid in Chinese yuan, not dollars. Yuan. Read that again and let it land. Because what I just described is no longer a proposal. It is not a theory. It is not a geopolitical threat being debated by analysts. It is a completed transaction, a precedent. The first yuan-denominated oil transit through the world's most important waterway in the 52-year history of the petrodollar system. A Turkish ship also passed. Chinese bulk carriers passed after their ownership was disclosed. The yuan corridor through Hormuz is not hypothetical. It is operational. And while every financial news channel is still covering this as a proposal, as something Iran is considering, the ships are already moving. In yuan, through the Strait, right now. My name is your host. This is the Stack Guy. Today I will show you exactly what this means for your silver stack, using specific, documented, real transactions from the last 48 hours. This is the most important video I have made for this channel, not because of what might happen, because of what I already did. Let me give you the complete, documented picture of what has occurred, because the pieces are scattered across news sources, and no one has assembled them into a single clear narrative for silver stackers. Piece 1. The Indian tanker. An Indian ship received direct assurances from Iran's ambassador in New Delhi that it would receive safe passage through the Strait of Hormuz. The condition, cargo settled in Chinese yuan. The Indian government, facing an energy crisis with over 85% of its crude oil imported and rapidly depleting dollar reserves, made the calculation. The tanker passed. Yuan was paid. The cargo moved. This is not a rumor. Athens News reported it on March 19, 2026. The report specifically names China, India, and Pakistan as the countries receiving safe passage under yuan settlement terms. Iran has created a tiered access system, what analysts are now calling the bifurcated oil market. Piece 2. Turkey. A Turkish ship was confirmed to have received permission to transit the Strait. Turkey is a NATO member. A NATO member's ship just transited the world's most important oil choke point by paying in Chinese yuan instead of US dollars. The geopolitical implications of that single fact should be reverberating through every treasury building, every central bank, and every precious metals desk on Earth. Piece 3. The Dark Fleet. Tracking firm Kepler estimates that Iran has shipped 12 million barrels since the conflict began on February 28th. TankerTrackers.com puts the number at 13.7 million barrels. That is roughly 1 million barrels per day moving despite the blockade, almost entirely to China, through shadow networks that route via Malaysia, Singapore, and Vietnam to avoid sanctions. The financial infrastructure for yuan-denominated Iranian oil has been operational for years. The Hormuz yuan condition is not building something new. It is bringing to the surface something that has been operating in the shadows at scale. Piece 4. mBridge. By November 2025, China's cross-border digital payment system, mBridge, had already processed over $55.5 billion in transactions. The digital yuan accounted for 95% of that volume. This is the financial plumbing through which yuan oil payments flow. It bypasses SWIFT. It bypasses US dollar clearing. It operates entirely outside the financial architecture that the United States uses to enforce sanctions and maintain dollar dominance. It already works. It is already at scale, and it is already being used for the exact transactions we are describing. Piece 5. The IEA warning. In its March 2026 report, the International Energy Agency, not a fringe publication, not a conspiracy newsletter, the primary intergovernmental energy authority, stated explicitly that the eventual reopening of the Strait and the currency through which oil passes could change the balance of power in the world economy for years to come. The IEA is not known for dramatic language. When the IEA uses the phrase, change the balance of power in the world economy for years to come, that is the institutional equivalent of a 5-alarm fire. Piece 6. Saudi Arabia. The country whose 1974 agreement with Henry Kissinger created the petrodollar system is now signaling, actively, not theoretically, that it is prepared to accept non-dollar payments for oil. Saudi Arabia is the linchpin. If the kingdom that built the system steps away from it, the system does not erode gradually. It restructures fundamentally. 6 pieces. All documented, all occurring in the last 48 hours or currently in progress. Not a theory, not a warning, a reality unfolding in real time. I want to introduce a concept that I believe is the single most important financial development of 2026, and that almost no mainstream financial coverage has clearly named: the bifurcated oil market. Before this war, there was one global oil price, one market, one currency. Brent crude is traded in US dollars on exchanges that operate in dollar clearing systems. Every country that needed oil accessed the same market, paid the same price, and needed the same currency. That single market reality ended on March 14, 2026, when Iran formalized what analysts are now describing as a two-tier pricing system. Tier 1, dollar buyers, countries that insist on paying for oil in US dollars, as required by the Petrodollar system, face the full reality of the Hormuz blockade. No passage, no oil from the Persian Gulf. Emergency reserves are running down at a rate that covers 7% of normal Hormuz flow. Oil prices elevated. Brent peaked at $126 per barrel, the highest since 2008. This is the war premium. You are paying for the privilege of using the dollar. Tier 2, yuan buyers. Countries willing to settle oil transactions in Chinese yuan receive something extraordinary in the current environment: safe passage through the Strait, 20 million barrels per day of normal Hormuz flow suddenly accessible. Energy security restored. The price, abandoning dollar settlement for this transaction. Iran has created a direct, visible, operational price signal for abandoning the petrodollar. The incentive is not abstract. It is the difference between energy security and energy crisis. The incentive is not future-oriented. It is immediate, today, this week. A CB-registered market expert, Anuj Gupta, quoted in Cryptopolitan's March 2026 coverage, said, "Any shift from the US dollar to the Chinese yuan in oil trade is expected to put pressure on the US dollar. In the wake of a sharp dollar decline, inflation rises sharply. The Fed is forced to raise interest rates. A liquidity crisis develops in the US economy. That chain of events, dollar pressure, inflation surge, Fed forced action, liquidity crisis, is the precise sequence that has historically produced the most significant precious metals bull markets. Every link in that chain benefits silver holders. The bifurcated market is not a future risk to the petrodollar, it is the present reality. And every day it operates, every day India, Turkey, and China move oil through Hormuz in yuan, it normalizes the alternative, it builds the precedent, it expands the infrastructure, it reduces the psychological and institutional barriers for the next country to make the same choice. Precedents are how systems change, not through dramatic collapses, through repeated, normalized, unremarkable transactions that quietly rewrite the rules. The title of this video says, "Silver Stackers Saw This Coming." I want to prove that claim, specifically by walking through the 5 signals the stacking community was paying attention to when most of the financial world was not. Signal 1, Russia's 2022 pivot. When the United States weaponized the dollar against Russia after the Ukraine invasion, freezing $300 billion in Russian foreign reserves, it sent a message to every country in the world that held dollar assets. The message was, your dollar reserves are not yours. They are a political instrument. Russia pivoted to yuan settlements for energy trade almost immediately. The stacking community watched this and understood the implication. Every country that saw Russia's reserves frozen began quietly diversifying away from dollar assets. The trend was set in 2022. Iran's 2026 move is its culmination. Signal 2, mBridge's quiet scaling. While mainstream financial media covered mBridge as a curiosity, a Chinese experiment in cross-border payments, the stacking community that follows monetary systems noticed something different. By November 2025, mBridge had processed $55.5 billion in transactions and had built the plumbing for exactly what is now happening in the Strait of Hormuz. You cannot run a yuan oil corridor through the world's most important waterway without a payment system that works. mBridge is that system. It was built, tested, and scaled while the mainstream financial press was writing about cryptocurrency speculation. Signal 3, China's oil futures market. The Shanghai International Energy Exchange launched yuan-denominated crude oil futures in 2018. The mainstream press dismissed them as irrelevant. Dollar futures dominated, volume was minimal, and the yuan was not convertible. But the stacking community understood the strategic intent. China was building an alternative price discovery mechanism for oil that operated in yuan. As those futures markets grew in volume each year, the infrastructure for a yuan oil market became more robust. By 2026, when Iran needed a yuan payment system for Hormuz oil, the Shanghai exchange was ready. Signal 4, the dollar share of global reserves. In 2001, the US dollar accounted for approximately 73% of global foreign exchange reserves. By 2024, that share had declined to approximately 58 to 60%, a 13-point decline over 2 decades, largely unreported as a trend because it moved slowly. But slow trends compound. The direction was unmistakable to anyone tracking the data. Every year, a smaller share of global savings was held in dollars. Every year, the structural demand for dollars that underpins the petrodollar was slightly weaker. The stacking community tracked this number. It said, the direction of travel is established. Physical assets become more valuable as the measuring stick weakens. Signal 5. The Kissinger precedent in reverse. In 1974, Henry Kissinger flew to Riyadh and offered military protection in exchange for dollar-priced oil. The stacking community understood the reverse logic. When countries believe they can secure the energy they need without the dollar, either because American military protection is no longer guaranteed or because an alternative protector emerges, the deal unravels. Trump's America. First foreign policy had been signaling reduced commitment to Middle East security guarantees for years. China was actively expanding its security presence in the region. The conditions for a Kissinger in reverse moment were building visibly for anyone paying attention. 5 signals, all public, all trackable, all pointing in the same direction for years before February 28, 2026. The stacking community was not prescient. It was simply paying attention to the data that the mainstream financial press was not covering clearly. I want to spend real time on Saudi Arabia because it is the factor that most coverage of the petrodollar story is treating as background, when it is actually the most consequential variable in the entire situation. The petrodollar was built on one country, Saudi Arabia. Henry Kissinger's 1974 deal with Riyadh was the foundation. OPEC followed Saudi Arabia's lead. The entire system rests on the kingdom's ongoing commitment to price oil in dollars and recycle those dollars through U.S. Treasury markets. As of March 2026, Saudi Arabia is showing active signals, not theoretical, not speculative, active documented signals, of willingness to accept non-dollar payments for oil. Read that sentence carefully. The country that built the petrodollar is showing willingness to unbuild it. Why now? 3 reasons that have converged simultaneously. First, China is Saudi Arabia's largest oil customer. China surpassed the United States as the world's largest oil importer years ago. Saudi Arabia's largest revenue source now comes from a country that is actively pushing yuan settlement, has built the payment infrastructure to support it, and is the anchor buyer for Iranian yuan-priced oil as well. The commercial gravity is undeniable. You price in the currency of your largest customer. Second, the mBridge precedent. Saudi Arabia is a participant in the mBridge digital payment system alongside China, UAE, Hong Kong, and Thailand. By November 2025, the UAE, one of Saudi Arabia's closest regional partners, was already processing significant volumes through mBridge in yuan. Saudi Arabia has been watching this work in real time with partners it trusts. The infrastructure risk is de-risked. Third, Trump's unpredictability. The security guarantee that was the other half of Kissinger's deal, American military protection for the Saudi royal family, has become less certain under an administration that has explicitly questioned the value of Middle East commitments and demanded payment for security arrangements. If the security side of the bargain is uncertain, the currency side becomes negotiable. Here is the scenario that every precious metals analyst is privately discussing, but few are saying publicly. If Saudi Arabia formally accepts yuan payments for even a portion of its oil sales, not all, not a complete switch, just a partial yuan acceptance, the petrodollar system as it has functioned since 1974 undergoes a structural transformation, not a collapse, a transformation, from a monopoly dollar system to a mixed dollar-yuan system. That transition, from monopoly to mixed, is the transition that removes the artificial dollar demand that has suppressed silver for 52 years. Not overnight, not in a straight line, but directionally, persistently, in the same direction that physical silver holders are positioned for. Saudi Arabia is the domino. Watch it carefully. Let me now connect every fact I have given you: the Indian tanker, the bifurcated market, the mBridge scale, the Saudi signals, directly to the silver price mechanism, because this is what the Stack Guy is built to do, not just explain geopolitics. Connect geopolitics to the metal in your hand. The connection runs through 4 specific channels. Understand all 4, and you understand why physical silver is positioned for exactly this environment. Channel 1. Dollar demand destruction. Every yuan-denominated oil transaction that occurs through Hormuz is a transaction that does not create demand for US dollars. The Indian tanker that passed yesterday, that oil payment did not flow through dollar clearing. It did not require India to sell rupees and buy dollars to pay for the cargo. It required India to access yuan, which it can do through direct currency swap agreements with China that have been in place since 2014. The structural global demand for dollars that the petrodollar creates, the demand that has artificially suppressed silver for 52 years, was reduced by exactly the volume of that transaction. One transaction is trivial. Normalized transactions at scale are structural. Channel 2, Inflation Transmission. Anuj Gupta's analysis quoted in Cryptopolitan is precise and important. Dollar decline from yuan oil trade transmits to higher U.S. inflation because imports become more expensive. Higher inflation is the single most powerful driver of monetary silver demand. Silver is a 5,000-year-old inflation hedge. Every percentage point of inflation that the dollar decline transmits into the American economy is a percentage point of additional monetary case for silver ownership. Channel 3, Fed trap deepening. The Federal Reserve is already trapped between inflation it cannot fight with rate hikes, because $39 trillion in national debt cannot sustain 20% interest rates, and growth it cannot stimulate with rate cuts, because 126th oil is already pushing inflation higher. Every yuan oil transaction that puts additional downward pressure on the dollar deepens this trap. A weaker dollar means more imported inflation. More imported inflation means the Fed cannot cut. Cannot cut means real yields stay negative or marginally positive. Negative real yields are the structural environment where silver performs best historically. Channel 4, Safe Haven Rotation. The Cryptopolitan analysis notes what financial analysts are saying directly. As the dollar comes under pressure from yuan oil trade, investors look for safer ground. Gold and silver are specifically named. The rotation from dollar assets to hard assets is not a future possibility. It is already beginning. COMEX gold inventories, silver dealer premiums, and ETF flow data all show accumulation from informed buyers who understand the mechanism. 4 channels, all currently active, all pointing the same direction, all benefiting the physical silver holder. The Indian tanker that passed through Hormuz yesterday did not just deliver oil. It delivered the clearest signal the precious metals market has received since Nixon closed the gold window in 1971. I want to be intellectually honest here, which means presenting the full picture, including America's options to respond. Because serious analysis requires understanding what could stop this trend, not just what drives it. America has 3 realistic options in response to the Yuan-Hormuz corridor. Let me walk through each and explain why all 3, in different ways, are bad for the dollar and good for silver. Option 1, military escalation to reopen Hormuz by force. America could attempt to force the Strait open through military action, destroying Iran's capacity to issue transit certificates and control tanker passage. This is the most direct response. The military capability exists, but the consequences are severe. Every day of military operation in the Gulf with oil above $100 adds to the inflationary shock already hitting the American economy. A shooting war in the Strait, with the risk of tanker sinkings, oil spills, and infrastructure destruction, could push oil to $150 or beyond. That level of energy shock would make the current Fed trap look mild. More inflation, more dollar pressure, more silver demand. Option 1 is bad for the dollar. Option 2, negotiation and a new deal. America could negotiate a deal that reopens Hormuz on dollar terms, offer Iran something, sanctions relief, security guarantees, economic agreements, in exchange for returning to dollar-denominated oil transit. This is the option that would be most stabilizing for the dollar in the short term. But here's the catch. The yuan precedent has already been set. Even if a deal is struck tomorrow, the world has now seen that yuan for passage works. India passed, Turkey passed. The institutional knowledge that the alternative exists and functions does not disappear because a ceasefire is reached. The bifurcated market infrastructure, mBridge, CAPS, the dark fleet networks, does not disappear. The genie is partially out of the bottle. Option 2 reduces the acute crisis, but does not restore the pre-war petrodollar status quo. Option 3, sanctions and financial pressure on yuan-paying countries. America could sanction India, Turkey, and other countries that have used yuan to transit Hormuz, threatening their access to dollar clearing systems if they continue. This is the nuclear option of financial warfare, and it has a serious problem. It would accelerate the very trend it is trying to stop. The lesson of the Russia sanctions, the lesson that the stacking community drew clearly in 2022, is that weaponizing the dollar drives countries to de-dollarize faster. Threatening India and Turkey with swift exclusion for buying oil in yuan would guarantee that India and Turkey accelerate their non-dollar payment infrastructure build-out. Option 3 is the most counterproductive response available. It destroys the case for holding dollars faster than any yuan oil transaction could. three options. Military escalation drives more inflation. Negotiation preserves the yuan precedent. Sanctions accelerate de-dollarization. In all three scenarios, the direction of travel for the dollar is downward, and the direction of travel for hard assets is upward. This is not a case where America has a clean exit. The petrodollar has been partially broken. The question is not whether it can be fully restored. The question is how fast the partial break becomes a larger one. I want to be direct, not financial advice. Do your own research, consult qualified professionals, never invest more than you can afford to lose. With that said, here is the framework that the documented facts of the last 48 hours support. Point 1. The thesis you built your stack on just got its first real-world validation. An Indian tanker paid in yuan and passed through Hormuz. That transaction is the petrodollar thesis made real, not theoretical, not predicted, executed. If you have held silver through flat prices and ridicule because you understood the petrodollar-silver connection, yesterday was your validation day. Hold. Point 2. The paper price does not reflect what happened yesterday. Silver is trading at $83.85 as of this morning. The paper market, driven by algorithmic traders, margin call mechanics, and Fed rate cut speculation, has not priced in the Indian tanker. It is not priced in mBridge at $55.5 billion. It is not priced in the Saudi signals. It is not priced in the IEA's warning about a reshaping of the world economy. The paper market is looking at interest rate differentials and dollar index movements. The physical market, where actual ounces change hands at expanding premiums, is beginning to price it in. The divergence between paper and physical is your opportunity. Point 3. The Indian tanker is one transaction. The bifurcated market is operational but not yet at scale. This is not the moment to expect a silver price explosion next week. It is the moment to be fully positioned before scale develops, before the normalized yuan oil transactions become dozens, then hundreds, then the new baseline. The window between the first precedent-setting transaction and the normalized baseline is where the best position building happens. That window is open right now. Point 4. Watch three specific signals over the next 30 days. First, how many additional yuan transit tankers are documented passing through Hormuz? Each one is a data point in the normalization process. Second, any statement from Saudi Arabia regarding yuan oil payment acceptance. That is the domino that changes the scale of this story from significant to historic. Third, Federal Reserve language about inflation and the dollar in their next communication. If the Fed acknowledges dollar pressure from energy market restructuring, the institutional precious metals case becomes undeniable. Point 5. Physical silver, not paper. I have said this in every video on this channel. I will say it here one more time because it has never been more relevant. The Indian tanker that passed through Hormuz in yuan created a transaction that bypassed dollar clearing entirely. The entire point of that transaction was to function independently of the dollar financial system. Your physical silver is the same thing in portfolio form, an asset that functions independently of the dollar financial system. That independence is not a feature you may need someday. Given what happened yesterday, it is a feature you need now. History turns on first transactions. The first Saudi oil sale in dollars in 1974 was a single transaction. It did not immediately replace gold as the dollar's anchor. It did not instantly create the petrodollar system. It was a transaction, a precedent that other transactions followed, one by one, until the precedent became the norm, until the norm became the system, until the system became the financial architecture of the world. Yesterday, an Indian tanker passed through the Strait of Hormuz and paid in Chinese yuan. It was a single transaction. It did not immediately end the petrodollar. It did not instantly replace the dollar as the global reserve currency. It did not transform the world's financial architecture overnight. It was a transaction, a precedent. The stacking community has spent years, some of us decades, understanding the petrodollar system well enough to know that when this moment came, it would look exactly like this. Not a dramatic announcement, not a formal declaration, a transaction, quiet, unreported by most channels, dismissed by the analysts who have been dismissing the petrodollar story for years. But the ships moved, in yuan, through the Strait. The IEA, not a silver channel, not a precious metals newsletter, the primary intergovernmental energy authority, said this could reshape the global economy for years. Saudi Arabia is showing signals of openness to the alternative. mBridge has processed $55.5 billion and is fully operational. The 52-year-old system that suppressed silver by artificially inflating dollar demand, the system that has been transferring wealth from hard asset savers to paper money holders since 1974, had its first transaction level breach yesterday. First transactions have a way of becoming last transactions for the systems they challenge. You stacked, You understood, you held. That is the stack guy. I will see you in the next one. If this video gave you the complete documented picture of what has already happened, not what might happen, what already did, please hit subscribe. This is what the stack guy does. Connect the facts that most channels miss to the metal that most people underestimate. I have one specific question for the comments. One that I want every single stacker watching this to answer. When you first heard that an Indian tanker paid in yuan to pass through Hormuz, what was your reaction? Relief that the thesis is validating? Urgency to add to your stack? Skepticism that it matters? I want to know where this community is mentally right now. Share this video. Specifically, share it with one person who told you silver was a waste of money, not to say I told you so, but because they deserve to understand what yesterday's transaction actually means, and because understanding it now, before it becomes mainstream news, is the only time it makes a practical difference. Stack physical. Own the precedent. See you in the next one.